How are you?
I'm very good, thank you. Okay, welcome to week 2 Zoom, and I'm going to be seeing you at the end on Saturday. So
Yeah.
what I'm going to be covering this Zoom is just going over some of the comments on the previous week assignment. That was mostly the cash flow analysis, and then I'm going to just chat about the coming assignment, and then I'll do some of the self-assessment questions that's under the financial analysis section. Okay, so last week we had an assignment in the McGraw-Hill application, or the Connect application, on Moodle, and on the Connect section. Some people strangely didn't seem to submit the Connect ones. I'm not sure exactly why, but I thought to just demonstrate this week later on. I'll show you where the assignment lies. So the application that you had to do was the general ledger and the trial balance, all the way through to the preparation of financial statements in the Connect interface. That marked it directly for you, and that was sort of instant, coupled with the quiz that also provided you with marks, and that should have given you some sort of delayed feedback in terms of where you went wrong. So what I'm going to be covering now is the cash flow analysis, and that was more relating to Netflix. Now, the way that you'll see the assignments happen, or how they're constructed in this course, it's not necessarily only calculations based, as that you could see from this cash flow analysis. So more and more we're going to be moving away from the numbers, and obviously the numbers are going to provide us an input for the analysis, but we need to take that further. So the case study provided us with Netflix, and now Netflix is one of those weird companies that are sitting with a massive negative cash flow, or a cash flow deficit on their books. Now, a couple of reasons why that is, and the two major ones is basically they are a growing company. They're not a startup, but they really in its infancy, and their model at the moment is spending a lot of cash in terms of buying content, and also generating content. Now, obviously, in that kind of industry, the content is really what's going to capture the market. Now, a lot of the credit rating agencies are saying, yes, they are they're going to continue to increase their negative cash flow position, but they're not too worried about it, because that's really the business model, and it should start subsiding in 2020. Now, that makes somebody like myself, who's an investor, quite uncomfortable because of the high financial leverage. Now, on further inspection of the cash flow, and the thing is that the cash flow works very much off two things. It is a direct interface, or it's from the income statement. Now, one of the biggest areas that flows into the cash flow statements is cash flow from operating activities. So that's basically the cash that you generate from your income statement. Now, you all know that in the income statement, it's not only cash flow items, there are some non-cash items. The biggest one for Netflix, if you analyzed the movements in the cash flow statement, was depreciation. Now, they were sitting with a massive depreciation amount, and that really, that big reversal of depreciation in the cash flow statement resulted in it posting quite a negative cash flow from operating activity. So what does that say to us if a company has got such high such high depreciation? So the thing what's worrying me about, just kind of objectively about Netflix, and I understand what the credit ratings are saying, is that they need subscribers to start growing their revenues more. But the thing is that it's very difficult to, the model in terms of Netflix and that kind of industry where you buy content, it's really short-lived assets. So what's happening is that they're buying assets, and it's recorded on their balance sheets as assets, but then it's quickly depreciated again. Now, what they are funding is that assets, that very short-lived assets, effectively. And that, as an analyst, makes me feel very uncomfortable. Because if it was a different business and, you slowly depreciate and the content, took a little bit longer to depreciate, that would be fine to fund assets that are a little bit more longer lived. but given the fact that you are funding purely depreciation. And I think people aren't making that link, because they're borrowing money and then it's coming. Yes, it's very temporarily recorded as an asset, but then immediately, very quickly then depreciated. So I don't like a business model that is borrowing money purely for that depreciation expense. That doesn't make sense. So that's one of the problems. And the second problem is that could be, but that had to be further analyzed, is another element coming through is the movement of working capital. So what does that mean? So remember now, the cash flow statement has got a couple of things flowing into. The first one we said was the cash generated from its revenue and expenses. Okay, now that obviously doesn't include depreciation. Okay, the second thing that flows into a cash flow statement is the stuff that you can find separately on the balance sheet, the movements of cash on the balance sheet. Now, obviously, if you buy a building, okay, that is a cash flow item, all right? But that wouldn't be hitting the top line of your cash flow statement under operating, right? That would be going more in your investing activities if it's kind of a building, right? But what is the movements on balance sheet that hits that first cash flow from operating activities? That is your movements in accounts receivable and suppliers, your working capital. That is also cash flow, because you need to fund your inventory, you need to fund your receivables, and you need to refund your creditors, or you get funded from your creditors rather. So the movement between your receivables, your creditors, and inventory is a cash flow movement. And that's obviously something that Netflix also can't get right. Obviously, they've got high receivables sitting there. So even though they might even be getting revenue, they are sitting with the receivables. So it's accrued revenue. It's not high quality because it's not hitting cash. Okay, so that's basically the two biggest areas why they are sitting in such big negative cash flow items, or from operating expenses. And then obviously from investing activities was marginally positive, but that's nothing to write home about. And then obviously on the financing side, it was this increase in borrowings that just exacerbated the financial risk of this company. So what is the implications? Obviously, it brings in high financial risk because it's borrowing money with no securitization behind it. It really is going into that depreciation line item, and that is not a good model. Other comments around that, you could have spoken about high quality of earnings. Now, you guys know from this week is that you can test your quality of earnings, and that's not high for Netflix. The other thing is obviously going into the interest rate environment. So they don't have the ability to raise more equity finance. Obviously, that's saturated. So they had to, they have to borrow to get themselves growing and getting more content, because that's really the problem with the model, is that as soon as you show the content, you need new content, and it's just a bit of a problem. And the problem is we are going into an interest rate hiking environment. Currently, interest rates are very low, but going into the hiking environment, that can really cause a dangerous situation. In the US in particular, we are seeing rates increasing, and that is going to start becoming a problem for many companies with financial leverage. And also from a funding perspective, surely they will hit some sort of saturation point of the amount of external borrowings they can. So currently their business model doesn't allow self-organic growth. They need to find external funding. So normally in a good business, you would want your revenues to be converted into cash so that you can then buy more content. And that's also another thing that you're seeing obviously in that receivables line. They're not converting revenue into cash. And that is a big problem. So what could you do? So obviously they could convert and get more strict in terms of the amount of receivables they have. Obviously they're going through this massive growth phase. Now, who knows whether that is now right or wrong? But one of the comments is, do you have to grow so aggressively? Perhaps in that industry you do. Maybe there's absolutely no other way than to just launch content after content. Otherwise, you're not going to increase your number of subscriptions. But there's other ways. You can increase advertising revenues. But definitely in South Africa, there was a talk that they were going to decrease subscription fees. I see that they didn't. but obviously maybe they could increase subscription fees. But the thing for Netflix is to grow that subscription revenue, and how they're going to do that, I actually don't know, but that's one of the strategies. Maybe market, maybe advertise more. They could partner with some competitors. Showmax did that with DSTV so that they could increase their subscription. They could do the same, and they could maybe diversify their strategy. At the moment, they're quite monoline in terms of this content. There's many other avenues that they could, many other areas they could diversify their revenue streams into. Perhaps they could get anchor shareholders that could inject equity into the business. So perhaps they need to be acquired by some big anchor shareholder. Maybe expand their content. So maybe do educational, different countries, different geographies. So yeah, there were many ways to perhaps look at combating their cash flow. But the biggest area is, how do you increase your subscription revenue and how do you decrease your receivables? So what it seems like at the moment is that to me, it's quite a desperate way of growing your business, in terms of you have to go into giving your customers credit. And I don't think that is a credit business in terms of media. Whether you want to give shows that people watch and now suddenly they've got to pay for this at a later stage. I don't think that's a good business model. And what is the consequences to that strategy? That would have depended on what you listed your strategy was. So obviously, if you mentioned that you needed to decrease your receivables, that would mean that you're not offering credit to customers. That means perhaps a loss of subscription revenue. Some people mentioned, increasing advertising. How would you feel if you're watching a program that you're paying for and now you're seeing all these adverts? So that just is frustrating, and perhaps you lose subscription on that account. Perhaps changing focus. So I know they're gunning for original content. They're spending a lot of money on their own content and premium content. Maybe diversify into lower grade content. Maybe provide more licensing fees. Again, partnering, but then again, you are giving away your content, so you're losing your grip on the market. Yes, and then those were a couple of key areas. So the point that I wanted to make about these assignments is that there's no wrong or right answers. So these things I felt were the most material elements that impacted Netflix. And that is definitely going to be the way that you need to look at assignments going forward. Yes, you will get marked through if you had other considerations. Not one person's assignment is going to look the same. You are marked through based on your logic and your analysis. That's the first point. The second point is what you can see. Now, you can't just say there's a negative cash flow number and then end it there. The point is, you need to see that you need to start analyzing, and you need to start delving deeper into the numbers and what they really are telling you about this business. Okay. And again, something like depreciation, we learned in week 1, where it felt so trivial, but now we are putting it in practice in terms of what does that depreciation really mean, and we're applying it to that particular business. So that's where week 1 was a bit of nuts and bolts, but now we're getting to the more interesting analysis type. Again, there's going to be a very similar assignment going forward, not only analyzing cash flow, but it's going to be analyzing a business. Now, that you can find in your McGraw-Hill application. So I've taken a snapshot for you guys, and you will see it, but now I'm so scared to push buttons. You can see it here. There's your chapter reading. That's not a graded self-assessment, but obviously you need to do that so that you can move on with week 2 individual application, and then week 2 your quiz. Now, again, I recommend that you attempt week 2 individual application before you attempt your weekly quiz, just so that you get quite a good understanding. But I would not leave this for Sunday night, because there's technical issues. Technology might leave a gap. And again, there's 2 parts to this individual application. Part 1, you complete this plain vanilla calculations on your Connect, and it's going to mark it instantly. There are only a few ratios that are tested here. Okay. Then you're going to go to Moodle, and there's a part B of this application, and you need to write a report. And there you need to perform financial analysis. You need to expand on the ratios that you believe are material and are relevant. Okay, so be it income statement, balance sheet, you need to decide. And as I explained to you now, you need to take the ratios and then explain them and analyze them. Now, that's not something that any textbook can teach you. So you need to do independent research. So for example, like this Netflix, open Google, research, what does that ratio really mean? Look for external data to compare. Because now what the theory tells you is like, you're going to be given one company. There's no external comparatives given. There's no trends given. You need to make sense. You need to develop a trend. You need to develop a comparison, and you need to analyze those trends and comparatives. But there is a word limit, so you're not going to do a whole year's work in one day. Stick to the word limit. Choose a few material ratios. So for example, there were many items on that cash flow that we could have spoken about that also exacerbates the cash flow problem. But the biggest one is the depreciation. So go through the financial statements and look for the most material drivers. This is going to be a pizza shop. So think about what that could be. You know, they've got customers, they've got cheese they've got to buy, they've got expenses, they maybe have marketing, you know. So think about the key core material drivers that could change this business. Okay. Is there any questions around the assignments in terms of the marks, in terms of how it's marked? Any questions around the assignments right now?
Okay, it's Pumrani here. Oh, sorry. Okay, Penny. Nicole.
How's it? Okay, go.
No, you can go first this way.
Who's first?
Okay.
Pumrani?
Oh, okay. No, I just want to understand the Moodle one. We have to open again on Moodle under the financial analysis. That's
right. And the Moodle will be based on the figures provided you in this individual application. So what I would do is to avoid any technological complications. Take a print screen of the financial statements of this company in this individual application.
Okay.
So that once you submit or you lose it or whatever the case, so before you open it, take a screenshot of the financial statements. Because remember, each one of you are going to get different financial information. Okay. For the same company, it's just slightly different. So once you click submit, it's going to give you new financial data. Okay, so I'm highlighting open week 2. This week 2 application, print screen and save it, or take WhatsApp photos or whatever you want to do to save that financial information.
Okay.
So that you have it. And then once you submit and it rejigs it, then you need to read part 2 and part A together so that you know what to expect for part B before you attempt this part A. Okay?
Yeah.
Okay. Any other questions?
Oh yes, just a quick one. What happens if our submissions are late on Connect? Do we automatically lose the mark, or do we get penalized, or what happens?
Yeah, so the quizzes are done. If you submit late on the applications and you highlight that it is now submitted, then you could potentially get a penalty on the applications, but the quizzes are closed. There's no reopening of the quizzes, I'm afraid. But you can.
No, mine was submitted and it was marked, but then they're telling me that they can't record it.
Excuse me?
I'm saying mine was submitted and I've got the mark on Connect, but on Moodle it says that I never submitted.
Okay. Can you please send... Oh, so it shows that and it shows the timing. I'll investigate. Will you please send myself and Shingi an email?
Okay.
Can I just bring clarity to the matter? If it is submitted after midnight,
yes,
you will be able on Connect to view your mark. It will show you, because Connect will show you your own work. However, it will not come to us. It will close off from us. So it will allow you as the student to refer back to the work, because we don't want you to lose your work. However, the mark does not reflect back to us. So the moment the quiz closes, whether it is the individual application or the test your knowledge or whatever, the mark automatically gets closed to us. We cannot do anything from it. But from the student's point of view, they can view it for their own learning. Because after the quiz, what they do get is the detailed feedback on their own work. But in as far as from our end, it automatically gets closed off because the policy has been set that way.
Okay, so, there we are.
Does that mean that then it does not count?
It does not.
Or what does it mean?
If the quiz is closed after midnight, it does not count. The only thing, if you go into your policy that has a policy to 10%, if you go through the assessment, is your individual application, which is an assignment. That one has a 10% per day late penalty, which is the one you submit on Moodle. So for example, this week, you have an individual application. The part A is a quiz on McGraw-Hill Connect, which accounts for the part A. If that one is not submitted by midnight, it's lost because it's a quiz. And then the part B, which is what you write, you can then, if you submit late, have a 10% per day deduction. But all quizzes per policy will not be entertained after the due date.
But Shingi, I'm talking about so for example, like let's say in the last week, we had the individual application, the preparation of financial statements.
Yes.
Section. So I understand the quiz. Once the quiz is closed, the quiz is closed. But the application, the preparation.
Including the application. So whatever work is on Connect, that's the policy that has been applied across the board for all courses.
Okay.
Yeah.
Okay.
Can I just ask, why can't they, I'm just thinking, because sometimes some of us, we work from home, your internet might be very slow. Why is there no extra sort of 10 minutes, not even a day, just to submit online? Because, I don't know.
They will not.
Yes, we want to submit early, but sometimes you have that thing. I'm just saying that, the 10 minutes, 5 minutes, 2 minutes, because I remember mine, like you said, it doesn't appear, because I sent immediately, I think at 12 exactly, not 11:59. So, that 1 minute then automatically get penalized.
The aim is, guys, you have to make your work prior to the deadline. If you go look at some of the major outcomes of the MBA, it is a combined outcome. It is meeting deadlines. That is one of the things that you have to do. So ensure that you, one, work on your internet connection, and number two, ensure that you meet all the deadlines in time.
Yeah.
But the biggest question is that all the other information is communicated with regards to our expectations, especially with penalties and stuff. But this specific one, I've worked through all the information that we were given in terms of the unit guide, the course material, and everything. It does not say anywhere that nothing like that. So I think it's a bit unfair. Yes, right. It's not fair on the lecturer as well.
What I will do is please click on all the links on Moodle. I will, if you'd like me to send the policy through to all the students, I will make sure that it's sent through. Is that okay?
Yeah, that's fine. So can I share it so that going forward, we know.
Okay, what I'll do is I will send through all the assignment policies just for you. I think it is, if you click through the policies attached on the links to your unit guides.
Okay, perfect. Thank you so much.
But just touching base on this thing, on the deadline, I'm just battling to understand, because this is Sunday 12 o'clock, and quite a few people then would have, in theory, wanted the 10% discount or the 10%. So I'm saying out of the 20 students that we've got now, we've got about 6 people that didn't submit on time. So that's just not acceptable. You know, so if we just take a step back from an analysis point of view, you know, I mean, these things happen once or twice, you know, but it just seems that this last week was a little bit en masse. And I think in that point of view, you know, the policy does apply. And, you know, we're all professionals here. And, you know, if this was a different varsity, you can't arrive for your test late. That's just not how it works, unfortunately. So yeah, that is the policy, but we'll send through the policy. I think the McGraw-Hill interface is working very well, because those people that attempted the quizzes, that attempted the self-assessment question, it is directly proportional in terms of the marks generated on the self-assessment flowed through to the quizzes. So please, guys, attempt your self-assessment questions for this week. That stems again from this chapter into your self-assessment. It's 25 questions. We'll go through them now. And then don't leave this individual application too late. The other thing that I also wanted to mention about this individual application and in this course is that clearly there is a element of analysis, because the theory will say to you, yeah, perform horizontal analysis, perform vertical analysis. It's like, what does that mean? That's that's a theoretical definition. So really, analysis takes some time. It takes also, and I'm free to bounce ideas off in terms of, you know, just having a support structure, an experienced support structure to lift your analysis skills to the next level. And that's really what would be key for this week's individual application, because even from the cash flow, because we had quite a number of non-submissions, I was extremely lenient on the cash flow analysis. But many assignments that was received was generic cut and copy and paste analysis, you know, in terms of strategies that didn't really relate to Netflix. Now, in this week, you're going to need to make it relevant to the underlying question. So please spend some time during the week just understanding what you need to do, because the thing is, there's three, there's the Connect interface and the Moodle interface, and to leave that for Sunday night to start figuring that out, and then you've got no one to ask questions, no one to bounce ideas, no one to help you with technical advice. Please just do that in advance, guys, please. This course is doable. It's really manageable, but, you know, it's things like non-submissions that, you know, if you just give it your all, you will make it through. Okay, so let's just move on. If there's no other administrative questions, sorry. Okay, so here's a couple of ratios, but again, they don't really take us through the actual analysis part, and that's what you're going to be doing in your application. So here we're just going through the mathematics of it. So let's just take this one. If the current ratio is 2, what will be the effect of the payment of a cash dividend, which was recorded as a liability on the date of declaration? So what is a current ratio of 2? Let's just go over that. It means if I take a proportion, because these ratios all interlink, and particularly in week 3, we're going to start really putting these ratios together to take performance measurement further. So we've got current ratio of 2/1. That gives us, and current ratio is current assets divided by current liabilities. So that if we take a proportion, a ratio is a ratio, no matter what, if we put it 4 and 2 here, it still remains 2, okay? So the relationship stays the same, and they're saying the current ratio is 2. What will the effect of a payment of a cash dividend, which was recorded as a liability on the date of declaration. Now, here, let's say we have a dividend of 0.5. We can take anything. We can take then, we can deduct that 0.5 off our current assets because that was then paid in cash. So 2 minus the theoretical cash dividend, just to show you the relationship, minus 0.5 is equal to 1.5. And then we also had that as a reduction of a liability. So 1 minus 0.5. So as you can see, because the cash dividend was an equal removal from the top and the bottom, we get a higher ratio because our current ratio was to begin with. If we take the same from the top of and the bottom, then it actually amplifies our ratio. So here we can see clearly that that will increase the current ratio. Okay, which of the following transactions increases both the quick ratio and the current ratio, assuming that both ratios are greater than 1? I think I left. Oh, okay. No, I didn't. Okay, so now we are going to, in a quiz scenario, they give you a couple of options. Now, if you know it off, quite quickly, then you can just go straight to the answer. But for me, I'm just going to take you through a couple of the theoretical concepts that's broader than just what you're seeing in the quiz. So here they're giving option 1, collecting an accounts receivable. So what would that entry be, okay, when we collect an accounts receivable? Sorry, I've just now moved it. What would the movement be of cash? If we collect an account receivable, it would increase our cash and it would decrease our receivable. So if, in effect, we've got no impact on our quick ratio or our current ratio. Why? Because quick ratio is equal to cash plus accounts receivable divided by liabilities, and our current ratio is equal to current assets divided by current liabilities. If we've got a movement at the top, it's an in and out, there's going to be no effect on these ratios. Okay? Option 2, purchasing inventory on account. What is that movement? We're going to increase our inventory, and we're also going to increase our current liability. Okay? So increase our current liabilities. So what is that going to do if you have a purchasing inventory on account? Now, if you assume that both are equal, greater than 1, if you do that ratio again, because this ratios are greater than 1, if you increase both sides by the same proportion, then you actually get a decrease in both ratios. What would happen in option 3 if we're accruing revenue earned at year end? Now, what is accrued revenue? It basically means that we have earned revenue, but we haven't actually received the cash. So it's an increase in our accounts receivables, an increase in our current assets. Let me just say current assets. And then it's a credit to revenue, which is sitting in our equity part. So that doesn't really impact. So this leg definitely only impacts the top line of both of these ratios. So that means it will increase both the quick ratio and the current ratio. Because we've recorded this receivable, it would increase both of these ratios. Does that make sense?
Yeah.
Everybody happy with that?
Yes.
Okay. So now option 4 is selling inventory on account at the cost of inventory. So let's just go through the flow of transaction through that. What would happen if we sell inventory on account? That means I'm going to have to credit my inventory as a start, because you don't have to call it credits, debits, but I'm going to say it's a decrease in my assets, okay? Well, I've sold it. So I need to remove it out of my inventory. Okay, and what have I debited? What happens if we reduce our assets? Where does that movement go normally? it goes into an expense, the same as depreciation. When we depreciate an asset, we reduce the value of the asset and it goes and sits in an expense. And that's exactly what we're going to say here. But this, for inventory, it just becomes cost of goods sold. And that is part of equity. So selling inventory on account, the first step is that you have to remove, it's a decrease in current assets. The second thing is now you've got to recognize revenue, and they say here at the cost of inventory. So there's no profit here. So you're going to say debit receivables. So that is an increase in current assets, and you're going to recognize revenue, which is in equity part of your transaction. So here you can see you've got an increase in your current assets, a receivable, and an equal reduction of your current assets because of the inventory that was reduced. Okay, so that means because you have done an equal and opposite increase and decrease of the same amount because there's no profit, that means your ratio doesn't change. Okay, makes sense, cool. So that's why it's quite nice to link this back to your accounting equation. When you're moving transactions through your accounting equation, then you can clearly see the increases and decreases and then the corresponding effect on your ratios. Okay, this one is a little bit, if we've got time, I'm going to go through that. Okay, now I can quickly, okay, now let me, this one is fairly, okay, let's quickly go through this. Which of the following correctly describes the effect of Mogul Company declaring and distributing a 10% common stock dividend? Okay, so as soon as a dividend is declared, there's a liability that is recognized. So we have to credit a liability. We have got to increase that liability because we've declared something that we now have an obligation to pay. So it becomes a liability, and we obviously have to decrease our equity. Okay, so which one of the following correctly describes the effect of the, so Mogul's current ratio decreased. Okay, so this is a liability. So the current ratio is equal to current assets over current liabilities. Now remember, if we are increasing the bottom, i.e. the current liabilities, in effect, our ratio does change. So if we increase the bottom, then that does have an impact on our current ratio. Mogul's return on equity decreased. What is return on equity? That is equal to net income divided by our average equity. Okay, but now we have decreased the our equity, so that is also applicable. So here, the third option is Mogul's debt to equity ratio remained the same. So that is probably the most accurate because of this exact in and out, in of equity, out of liability means that we've got an equal and opposite increase and decrease of our debt to equity ratio. So that means our debt to equity ratio stayed the same. And then Mogul's return on assets decreased. Now remember what return on assets equals. That is equal to our net income divided by average assets. We had no impact on our net income, and we also had no impact on our average assets. So that one will also not apply. Any questions around this one?
Nope.
Okay. So which of the following ratios increases when inventory is sold on account for a price equal to its original cost? So here's the exact same inventory transaction. We've got to remove the inventory and transfer that to the expense line as part of our cost of sales. But we're also going to take it through to equity as our cost of sales. We then have to raise a receivable and then also the revenue that we have earned. So which ratio increases? Let's take it one by one. Current ratio. So obviously here we've got an equal and opposite movement in our current of our current assets. So that means that nothing will happen to our current ratios. But let's look at our quick ratio and what the quick ratio actually means. Oh, I've copied that now somewhere else. I'll just quickly take that through. Quick ratio is equal to cash plus accounts receivable divided by liabilities. Can you see that the quick ratio does not include inventory?
Yes.
So what have we done here? We've reduced our inventory and increased our receivables. So that means that the quick ratio will increase because it doesn't have an in and out in the top line because inventory is excluded here. So that's why the quick ratio will change. Let's look at ROA because it's similar to question 16 that we just had. We had net income over average assets. So obviously average assets won't change because here average assets includes both receivables and inventory. So because we've got an in and out there, that won't change. And then again, return on equity will not change. Why? Because of the fact that the inventory was actually sold at the same, there's no profit. So because we have an equal in and out of revenue, a plus and a minus, there's no effect on net income and there's no profit, and therefore equity doesn't change either. And that's why that one won't change. If they had to change it and said that there was a profit, then I would not agree. Then your return on assets and your return on equity would change. Okay. Now, this one gets a little bit more complicated. Which of the following transactions decreases the earnings quality ratio? Now, what is the earnings quality ratio? It is calculated as cash flow from operating activities divided by net income. Now, we need to keep in mind what is included in that cash flow from operating activities. Remember, we start off, it's basically our net income, reverse interest expense, reverse investing activities income. So really what we're left with is only the cash flow from our operations. We've also then reversed depreciation and other non-accounting stuff or other accounting non-cash items. Okay. The other element that's coming into this cash flow from operating activities is the movement of our receivables, creditors. Because remember, that is a cash flow. And that is a cash flow that comes from the balance sheet movement into a cash flow from operating activities. So let's just go through what happens here. Which of the following transactions decreases our earnings quality? Okay, so that means it makes our cash flow from operating activities less relative to our original net income. Okay, so 1, the accrual of interest expense. What would that flow of information be? Our liability would increase because we have raised interest, which is an expense, and that's part of equity. Does this part hit cash flow from operating activities? No, it's a financing transaction, so it wouldn't hit these. So that's why it wouldn't affect your quality of earnings. Option 2, collecting cash on account receivable. You are debiting cash and credit receivables. And this, so you are collecting a debtor, your receivables, somebody is paying you. And that's why you can now start seeing, if you take the flow of transaction, how that is a cash. It's hitting your bank account. And therefore, it is a cash flow item. And therefore, it is cash flow from operating activities. Why? Because it's your receivables. It's your main trade. Okay. So, a cash in and out is, however, sorry, just to rephrase that. So a receivable on account of a cash inflow is not necessarily a movement. So if I had said credited my revenue, debited my receivable, that means it's a decrease of cash to me because I've given inventory away and I'm funding that receivable. But once so I've already recorded that cash flow movement, that negative cash flow. So this cash in and out is a pure in and out of my cash flow from operating activities. So it doesn't hit my cash flow from operating activities. Now let's look at option 3 and see if it gets starts becoming different for you. we are selling inventory on account for a profit. So here we have got debit cost of sales, credit inventory. So let's put some figures to this just for a minute here. Let's say our inventory cost us 80 Rand and we have expensed that, okay? But let's say we have paid we've sold it for 100 Rand. Here suddenly you can see that I'm starting having a negative cash flow element because I've had to fund my, there's a debit, it's a reduction in my receivables. I don't get money for it. It's on account, and that is a negative element to me. So that means there's going to be a net effect of 20 that I'm going to have to fund, and that definitely hits my cash flow from operating earnings. That movement in current assets is what hits my cash from operating activities. So that's why selling inventory on account for a profit would mean a cash. If I had to say that this was for no profit, that means that is an equal and opposite movement in my income statement. Then there's no cash effect. So it is purely for the profit that makes it a cash flow item. Making a payment. And also, sorry, let's just think. Yeah, okay, that's what I wanted to say. Making a payment or principal on a loan, of course, that does not hit our operating cash flow from operating activities. Also, sorry, just one element that is can also be seen here. Let's just go back and make this back to 100. Is that now we've got 20 Rand profit here. So what is also going to happen is look again at what this ratio really means. The earnings quality ratio is calculated cash flow from operating activities divided by net income. So now think about, I've got this increase of my net income of 20 Rand, which is really a non-cash. It's a profit line. I've recorded that as revenue. That's non-cash. It's an accounting thing. So now I've got an increase of 20 at my bottom line, but not a corresponding increase of cash from our operating activities. And from that account also reduces the quality of earnings ratio. Okay. The year-end adjusting entry to record bad debt expense will increase which of the following ratios? So let's just think about what the bad debt expense is. It is going to be a debit to bad debt. Now, what is that? That's an expense. And that is going to be the equity side of our accounting entry. Then we are going to credit our receivables, which is also a reduction of our asset. We're going to make it less. Why? Because we're writing it off. We're removing it from our balance sheet. Okay, so which will increase the ratio? So let's just go here. Sorry, this is a reduction of a current asset. Okay, so we've made it less. So which ones are going to increase the following ratio? Will our current ratio increase? Remember, our current ratio is equal to current assets divided by current liabilities. What have we done? We've reduced our current assets. That means we've reduced this top line. That means our current ratio will decrease, not increase. Earnings quality. What is earnings quality? That is cash flow from operating activities divided by net income. What have we done in our net income? We've reduced our net income. So that means we've made this element smaller. Will it therefore increase our quality of earnings? Bizarrely so. Weirdly. So bad debt expense can actually increase what our quality of earnings can look like. That is actually a huge part of analysis that can really almost distort quality of earnings. Because here you've got bad expenses coming through, and then suddenly your earnings, your quality of earnings starts looking better. Something I've now just realized. Okay, quick ratio. So the quick ratio is again the our cash plus our accounts receivable. Here we have reduced the top line, our accounts receivable, and obviously that reduces net profit margin. That is going to reduce. Why? Because we had to record this expense in our net income. So if we then record our net profit margin, then that would reduce. Okay, guys, I think this is all about the same, and I think that's why I'm going to leave it here. I don't know, yeah, because this is exactly the same concepts, and I think you can just copy and paste further. So I hope this helps you in terms of trying to understand the ratios a bit better. I don't know if there's any questions around what you need to do for this week so far, or any of the ratios that you don't understand. I'm more than happy to answer questions.
Are you going to share the spreadsheet with us, Nicole?
I will email it immediately so you can have it, should then come through. And then what I also just like to say, I don't know if you've received an email about the preparation of for class on Saturday. So this is not a long thing that you have to do, but we are going to open it up for the floor for discussion. So what we really are going to be discussing on Saturday is very interesting. This is basically why we are here, and we're going to be discussing performance measurement. And a big part of that is how to incentivize management or employees for things that really were in their control and actually had a causality. So, for example, let's just take a bank, for example, that had, that did well despite interest rate decreases. Now, clearly, that was not, the interest rate decrease was not, it was the cause of the reasons why the bank's earnings declined, but it wasn't a cause for maybe not incentivizing management, because maybe management really did steer the company well despite this decreasing interest rate. So the requirement for Saturdays, you must just check your emails, is there. You must just please think of one example or an area that you've already, that's you've experienced that that has got a causality in terms of how performance can be measured with something that has got a cause and an effect. That really is under management control. So that's really what we're going to be discussing. So please prepare for that. It won't take you longer than 10 minutes just to read the Freakonomics article. It's very, very quick. And then we can have a meaning discussion in Saturday's lesson. It would really, be meaningful for your business in terms of your application and your learning experience. So I look forward to seeing you there on Saturday. I'll send this now out immediately. And if there's any other questions.
Hi, Nicole.
Hello, Anna.
Hi. Let's say I get for example, net profit margin percentage wrong in part 1 on my assignment. And then when I'm doing my analysis, I continue with my wrong answer. Are you going to penalize me?
No, absolutely not. So obviously, you would have been penalized already in the first part. So I can't penalize you again in the second part for those ones that already relate to part 1. So, however, in part B, I urge you to not only stick to the ratios that was tested in part 1. You need to expand on the ratios. It's an open-ended assignment. So if somebody is giving you part 1 is merely just to guide you and steer you in terms of how to get going. And then part 2 of the assignment is, so that's why I don't expect anybody's to look the same in terms of how they're going to analyze the business. Does that answer your question?
Answered, yeah.
Okay.
Yes.
So I highly recommend you, because we're seeing each other on Saturday, please just have a look, just read through the assignment. Again, I urge you to push print screen on the financial information in Connect so that you don't lose it. Because as soon as you submit, a new scenario will be presented to you. Okay, so you need to capture that information that is relevant to your company at that point in time. Okay. And just start thinking about the depth of analysis that you need to do. And you can ask me then on Saturday. Okay.
Good.
Right.
Any other questions?
No.
Okay, guys.
Thanks,
You
Nicole.
guys, it's a pleasure. Take care, and we'll see you on Saturday. Bye.
Bye-bye.
Bye.